Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry Monday Market Update webinar. Through this live stream and webinar, we will be doing some fundamental and technical analysis to map out trade ideas on gold, XAUUSD, GBPJPY, GBPUSD, EURUSD, USD Cad, and US30 stock market index. Through that analysis process, the first thing we're going to do is look at what economic events we have on the table that can impact the trading instruments that I just laid out, and also focus on what fundamentals we currently have in play that is dominating the market sentiment, as we can continue to use that to our advantage. Another key point and reminder to focus on is that we're still very early into the new year. So we are seeing some order flow setup for the start of the new fiscal year. And I'll explain what I mean by that as I'm breaking down the analysis on some significant pairs. Okay, so let's just start off here by going through some of the economic events on the docket. But pretty much we don't have that much in focus in terms of what we have through Asian session tonight and London session to come. 1 second here. Are people having issues with the audio? Is it all good? Can you guys hear me? Some people are saying audio issues. Hello, hello. First market update of 2022. Okay, audio's good. Audio's good. Okay, cool. All right, so anyways, so that means you guys heard everything I said. All right, so I'm just going to continue on, all right? So first thing we're going to look at is the economic data we have on the docket here, which is primarily through Asian session. We have some Australian economic data with the, New Zealand economic data. They got very similar flags with the monthly retail sales and the trade balance figures. And that's pretty much it for the Asian session, which is just going to be impacting the New Zealand dollar. So just keep an eye out for that if you trade any NZD pairs. Through this webinar, we don't break down any NZD pairs or focus on that risk currency. We're just going to be breaking down the pairs listed and going and taking our time going through that. So overnight, 3 a.m. Eastern to impact Eurozone, we do have a medium-term report for Spain with some industrial output data, but primarily it's a pretty quiet day in terms of economic data through the London session and New York session to come. There's not really any UK or Eurozone major economic data or any major US or North American data during the New York session. So it's pretty quiet overall. Not too much to focus on in terms of economic data is the key takeaway point. We're primarily going to be looking at market structure, fundamental market sentiment, and so forth, and understanding that we're very early into the new year for the new fiscal year order flow setup. So we're going to do a quick refresher on the higher time frames as well. Okay, now in terms of market sentiment, you can see that global equities, besides the Hang Seng market, which that is China, that's its own individual impacting factors for why the stock market's been weaker in China. But the main global regions like Asia Pac, encasing Japan and Australia, Eurozone here just signaled out with the German DAX, UK 100 for obviously the United Kingdom, US 30 as an example of equity flow movement for the US markets and North American markets. You can see primarily across the board, we have been extremely bullish as investors have been riding the wave of increased inflation, low interest rates, and central bank stimulus. But as we're starting off the new year now and we're getting central banks turning on a more hawkish tone, which I'll discuss in the fundamental impacting factors in a second, you can see we're getting some profit taking by buyers and liquidating of positions by buyers. That's creating a more aggressive pullback on the equity markets, which is completely normal and expected, because you have to think about this from just an investor perspective. These investors and smart money that have been riding the stock market buys have been riding this wave for a specific reason over the last period of 2 years. And those reasons that created this bullish wave on the equity markets being obviously the injections by the central banks, the increase in inflation, the low interest rates, the amount of buyers pooling in to ride that wave in itself pushes price up even further. As they've made these huge percentile amount of gains over the last 2 years, eventually you are going to see market corrections as the central bank shifts their policy positioning and makes the investing environment no longer as appealing. What I mean by that is tapering the stimulus support, hiking and raising interest rates, and this gives perfect reason for a market correction to start to enter the scene, and those buyers that have been riding this wave for 2 years to liquidate some positions out of the market, the same time you have a shift in the economic cycle. Does that make sense for everybody? Because what I want to continue on and talk about is that what we have seen to start out this new fiscal year is with the last FOMC meeting minutes, which was just obviously the prior week, we saw that the Feds brought a more hawkish tone where they want to start combating the increasing inflation, and they want to start shifting their policy positioning to obviously look to do more aggressive rate hikes and tapering of stimulus, right? So what this does in terms of economic impact, it's not just the things that we trade. In the overall economies, you're going to see various assets and commodities that were supported by the low interest rates and very favorable low prices years ago, and of course the increasing inflation. All of these are going to enter a corrective cycle, a bearish cycle. All these commodities that have been so bullish, such as gold or oil over the last period of 2 years and have had such a strong bullish run in 2-year period, the equity stock markets, everything from lumber to soy to other basic commodities and so forth, right? It's just the economic cycles that continue to repeat through history, because you're going to have the inverse impact of what the low interest rates were causing, right? But anyways, so the Feds are showing us a more hawkish tone towards going towards rate hikes, and other central banks are really going to start to follow suit and continue down that path. Because from an economic fear standpoint, a lot of the fear regarding COVID and coronavirus has been priced into the markets, and we haven't had really, for the major global players like the UK, Eurozone, Canada as a whole, the USA, and some major Asian countries, majority of these major players have been out of lockdowns and have been having economic data rebound to pre-pandemic levels, like in the labor market with retail sales and so forth and other economic activity. So a lot of economic data for countries across the world, because we've been out of lockdown for so long, has been rebounding to pre-pandemic levels, which just gives further signals that central banks can start to shift into rising interest rates, right? And starting to taper off and stop the stimulus support. And obviously we'll have a shift in the market sentiment and market cycle, okay? So anyways, to start off the year, we're seeing some exhaustion on equities, which is good to play to our advantage. At the same time, we're seeing that exhaustion on equities. We're still seeing respect to this demand zone on the volatility index and a fail to break, and a pretty aggressive bounce off there for the time being. Japanese yen is doing a pullback from its lows printed as we're just starting off the new year. And the US dollar is still bullish, just in a consolidation zone, which is still respecting bullish market structure. So my anticipation is, as we continue on into the week, if US economic data is still solid, if the Federal Reserve continues to give clues and signals towards rate hikes to come and continues to extend that sentiment from FOMC meeting minutes, what we can expect to see is a deeper pullback and correction on the Japanese yen from these lows, which can even extend to 87 and 88. Keep that in mind, because we can use that to our advantage when we're trading JPY pairs. we focus on GJ, but you can use the Japanese yen index movement individually, understanding when it's moving with trend or when it's in a pullback. If you can trade any yen pair, EJ, UJ, you can use these confluences and correlations accordingly, right? But keep this in mind of the potential pullback Japanese yen can enter, because it's very normal as you have these lows printed that you can have some aggressive pullback plays where the same time, if you correlate the dates of when the pullbacks occur, there's probably a 90% probability that the same time Japanese yen individually is doing a bullish pullback, that the Japanese yen pairs you trade like EJ, GJ, AJ are going down, right? Because the Japanese yen movement individually holds a lot of strength as it's a safe haven currency. So against whatever basket of risk currencies, you're going to see you can use that correlation to your advantage, right? But what I want you to understand is being able to read those market waves of when we have these lows printed and potential pullback phases that can occur in the market. So seeing a potential pullback or some short-term bulls on the Japanese yen as we peaked new lows and are starting off a new fiscal year to set up better sells in the long term is very viable of seeing some short-term upside on the yen. This is going to line up very well when you look at pairs like GJ or EJ, which are at previous intraday highs or higher time frame highs, which I'll show you in a second, and can also show potential for some exhaustion and pullback from their highs. So anyways, in expectations of market sentiment, I'm still looking to play US dollar strength bias, US dollar bulls. Keep that in mind because we're going to use that to our advantage when we're looking at gold, GU, EURUSD, USD-CAD, and US equities. I'm still looking to play a short-term bullish pullback bias on the Japanese yen. So some short-term expectations of bulls on the yen that we can use to our advantage on GJ correlation. And I still expect VIX to at least, if it holds above the 16 demand zone, to at least go up to retest these previous intraday high price points at the 27 supply zone, which would give us a deeper correction on the equity markets. Okay? So now, because I was talking about the Japanese yen individually, and the only yen pair we focus on is GJ, let's do our GJ analysis first. And I want to show you guys something very interesting from a technical perspective, okay? Number one, weekly higher time frames. You can see from this demand zone we were respecting, this is the last price point of interest on the higher time frame at the 150s that's maintaining bullish market structure. Anytime we've had a high printed by buyers, we always have a pullback to this demand zone where we have more buy orders collected from better favorable price points that the institutions and market whales want. And every single run off this demand zone has extended into potentially higher highs or at least revisiting the previous highs, right? What's very interesting is to start off the new year already, we've already had a pullback to this demand zone again and an upside run that went to revisit the previous high but has failed to break so far. What this is showing me, the same time the Japanese yen is holding short-term strength, is that we are entering a potential pullback market of buyers taking profit in liquidating positions from the previous highs, which can potentially create an intraday pullback and short-term bears on GJ to take advantage of. So some key points you want to look at here is the rejection we're getting at the significant previous higher time frame high. And the same time, you're going to see something very interesting on the intraday time frame. So now look at the 4-hour time frame here, right? And I want to show you guys two runs of price action at exactly similar price points of interest as well, okay? This in blue is that daily demand zone I was talking about, where we've always had a pullback down to this zone and more buy orders collected in the market, right? We'll mark that out as a bright green, actually, as a buyer demand zone, okay? You can see, technically, from this buyer demand zone, you create a technical double bottom. What this double bottom tells you from a order flow perspective behind the scenes is that as we push price down to this buyer demand zone, sellers are liquidating positions and buy orders are being collected from these price points, right? You can see that from the bullish run to the left that extended up to 157.5, the bullish run we saw for the start of this new year is from the exact same demand zone, and even the double bottom leg before you have a continued bullish run and breakout is at the exact same price of the 152.5 key level. You can drag right across the board here, right? You can see the double bottom leg here, double bottom leg here. And as you break above that price point, you signal a lot more buyer order flow in the market, and you have this very strong bullish run all the way up to that higher time frame supply zone, pretty much exact same price point, right? Now, remember, it's the start of a new year where we can easily have deeper pullbacks and liquidity grabs. And look at this technical repetition we've seen from this supply zone before. You can see GJ starts to enter this bearish pullback structure. And if you were to go and check the date here around the end of October, you're going to see Japanese yen was doing a pullback during that period as well individually, but I'll show you that in a second. But anyways, as buyers entered from this demand zone, extended price almost 1,000 pips from like 148.8 up to 158.5, almost 900 plus pips. You see buyers liquidate positions from this area, then you enter this bearish corrective pullback structure, right? That's almost the exact same technical repetition we're starting to see take place here. The only difference here is that this impulsive drop to the left here, that came from Bank of England not increasing interest rates. At the last Bank of England rate decision meeting, they went against expectations and they didn't increase interest rates. This led to a devaluation of the currency in the short term in this impulsive move. I don't expect us to have this take place. What I expect us to do is do a 50% correction of this impulsive buyer's run, roughly come back to 155 or 154.5, have a pullback and go to collect more buy orders in the market from there before continuing back up bullish. Okay, so now remember here, October 11th, October 20th area, right? Around mid-October here, you can see around mid-October to the start of November, which I was talking about on GJ here. This is around mid-October to the start of November area where you start to have this bearish market structure on GJ. And you can see that bearish market structure lasts for weeks. So as a scalper or day trader, you have to adapt to that market wave accordingly. But what I want to show you is from that same date, you can see the correlation of Japanese yen movement individually, where Japanese yen after printing a low has a pullback phase for a period of weeks before continuing back down. Right? Does that make sense to everybody? The same time Japanese yen after printing a low individually starts to do a bullish pullback is also the same time GJ buyers print that high and you start to get a bearish pullback on GJ. So the same time here on GJ, as we have this bearish corrective structure forming at those intraday highs printed by buyers, we can also see to start off the new year, Japanese yen by itself individually is also doing a bullish pullback. So what I want us to do for the time being is play this corrective pullback structure. So my expectations are for the next period of days and weeks, as we're still starting out the new year, if we don't break below 156.2, these current lows printed, that we're gonna continue this descending channel in this fashion, right? So what I would be looking for, if we have the same repetition technically to the left like we had here, and look at this for example, and look how beautiful that pullback bearish structure is if you play it correctly. So this bearish pullback structure, you can see, lasted almost a period of 2 weeks, right? I don't know if you can see the dates at the bottom, but it lasted a period of 2 weeks, this pullback structure here on the 4-hour chart. And you can see as you're having these intraday lows printed, you get these aggressive pullback plays and you play in this descending channel. But within this descending channel, these are strong intraday movements of 50 pips, 100 pips, and very nice favorable scalps as well. But you have to play those waves accordingly, right? So, pop quiz first right now. You can't really see higher time frame continuation buys unless you broke above 157.5. That would show you that this pullback structure is complete, meaning buy orders are collected from a more favorable demanded price point, and you'd have to break above that high to signal new highs being printed by buyers, right? So with that being said, just play this corrective pullback structure for the time being and these potential trade ideas. If we pull back to 156.200, very similar to like how you had a low printed here, then you did a break and retest above the secondary PPL before continuing up, I'd be looking for these corrective pullback buys here, playing this descending channel, buys above 156.5, starting to look for sells at 157 and scaling back below. Or if we just break these lows, I'd look for some continuation sells. Confirms being just remaining in this descending channel, the repetition of market structure and technical repetition of buyers and sellers order flow I just showed you to the left, as well as Japanese yen individually also being in some pullback structure. Does that make sense for everybody? No, Deltacron does not have any impact. For Deltacron to have impact, it has to lead to countries' governments initiating lockdowns, which would impact economic activity. Okay, now, so that was analysis on GJ and also the yen individually. We can also see some of the exhaustion we're starting to get on equity markets to start off the new year, as obviously central banks are going towards more a hawkish tone. Now, in terms of correlation and fundamental sentiment, we can see the US dollar individually is still very bullish, right? It's just in a consolidation zone here. From pretty much the end of the fiscal year to the start of this new year. But overall, ever since the Federal Reserve has been giving signals towards tapering, started the tapering, we've had stronger and stronger US economic data, regardless of what they try to say in terms of the mainstream media for fear mongering. The numbers don't lie. Economic data is rebounding to pre-pandemic levels. The US has been out of a lockdown, and we can see that the dollar with investors have been pricing this in further as we have respect to this bullish market structure and an overall very nice trend. We're just in this higher time frame consolidation zone. But for me, consolidation zone are more like order collection areas that we identify based on technical analysis, where if we don't break the lows of this consolidation zone, I still have the expectations to continue more bullish, especially if US economic data continues to rebound. Okay, So the main takeaway point I'm trying to describe there is I'm still in a dollar bullish bias. Even if we do get a deeper pullback to like 95.4, we're still very bullish on the US dollar. We've just seen some of the buyer volume slow down towards the end of the year and start of this new year so far, and we've been in a consolidation zone. But I want to show you something that's very interesting. The same time the dollar is bullish and had buyers print new highs, then entered this bullish expected consolidation zone, is the exact inverse of what you can see on EURUSD, where sellers printed new lows, and you can see we're in this consolidation zone at new lows, right? And you can even see the structure of EURUSD and GBPUSD is the inverse of the dollar index movement and overall US dollar movement. Because it's the world's reserve currency and the world business currency, it dominates whatever pair it's in, right? So you can use this correlation to your example. GBPUSD is different, where the way GBPUSD the pair behaves, it doesn't do as aggressive consolidations. What GU does is more aggressive pullbacks from lows printed. But you can see the overall bearish market structure still stays intact. And I want to show you something interesting about when sellers come into play on GBPUSD as well. But anyways, the main takeaway point of what I'm trying to describe is as long as dollar still holds above 95, 95.5, or starts to break above 96.6, I'm still in a bullish bias on the dollar. Now, when you're looking at this GBPUSD bearish market structure, right? I want you guys to notice something very carefully. You can see as sellers continuously print lower lows, whenever the dollar is consolidating or the dollar is in pullback structure, you can line up the dates that GU also enters this pullback bullish structure to retest better sell areas, which can oftentimes also be mapped out with a bullish trend line on the intraday time frames. But overall, the bearish market structure integrity is still maintained. And what's also very interesting is that as you go to retest supply zones and better sell areas where more sell orders enter the market, you can see before you have significant drops, you have multiple retests to a supply zone and order blocks created before continuing your way to the downside and getting the break of the corrective bullish market structure and continuing your way right back down with the higher time frame trend to revisit the previous lows or continue into lower lows, right? So this market structure has been respected the same time the dollar has been in that bullish market structure because of the fundamental reason stated of US not being in a lockdown, the Federal Reserve giving more signals towards tapering, starting the tapering process, talking about rate hikes, talking about inflation no longer being transitory. And you can see at very significant price points like 1.36, 1.38 flat, 1.395, 1.415 flat, or 42. At very significant price points in supply zones, you have sell orders enter the market and continuations right back to the downside. Okay? So what we can see here is we are in that potential sell zone starting to develop. But I expect us, very similar to previous times we've visited these sell zones, that on the intraday time frames, you can revisit these sell areas multiple times before breaking. And you can see here, you consolidate at that sell zone for almost 10 days, right? Here, before dropping and continuing back down, you can see sellers collect order flow in the sell zone multiple times, and this lasts almost a week before actually continuing down. And sometimes it looks like you're going to break a bit higher even, and you snap right back into bearish market structure. Same thing here. You can see you retest this area multiple times before finally starting to shift back down, right? So with that being said, we're still respecting this current bullish corrective structure from the lows as the dollar's consolidating. But even if we break a bit higher to 365 at this point on, hold below 36, break below 354, or shift out of structure at 35, I'm starting to look for sells on GBPUSD because we're still maintaining that overall bearish market structure on the higher time frames and US dollar strength dominance, with FOMC hawkish meeting minutes tone still holding some fundamental weight and US economic data being a lot stronger as well. I would only shift out of this bias if we had breaks in retests above 1.365, which we do not. US dollar still holding some of that strength as well. I could see us getting deeper pullbacks and upside moves, and it would just be like liquidity grabs, just like we've seen multiple times here, where you have a large bullish run from a low printed, huge liquidity grabs and multiple retests fail to break. Just like we saw here from these lows printed, you have a pretty large bullish run for an extended period of weeks, but at significant bearish market structure retest points, you retest those areas multiple times. That's exactly what we're starting to see repeat here, and the fundamentals also support that potential sellers coming into play. Only shifting out of this bias above 1.365. Okay. Now, EURUSD is going to be just looking to play the sell side of this consolidation zone, where we might sweep the highs a little bit, but overall, when you're looking at EURUSD, you can see that it's very normal for EURUSD to have these higher time frame consolidation zones, not break to the upside of these consolidation zones, just having more sell orders collected and continuing your way back to the downside, especially if US dollar strength continues to hold, and we're still respecting this overall bearish market structure on the higher time frames, with sellers continuously printing lower lows. Right? At the same time, dollar is just in that higher time frame bullish consolidation zone. Okay? So my expectations on EURUSD is if we come up to like 1.14 flat, would still be looking for sells in this area. Sells below 1.27. Sells below 1.125. This would just be a deeper pullback for obviously the new yearly order flow setup, but still playing the US dollar strength, entries at key levels, sticking to the bearish higher time frame trend and structure, and potential shift in central bank policy positions, mainly the Feds. I could only shift out of this bias if we had dollar weakness and a break above 1.147, which would be breaking near above previous lows and also shifting out of the bearish market structure, showing a lot more buyer order flow in the market. But in combination with that shift of structure, there need to be some fundamentals like dollar weakness to confirm that breakout. Otherwise, we're just in a consolidation zone, still respecting the bears. Now, USD Cad, which has the US dollar as the primary and the dollar has been more bullish, and the Canadian dollar risk currency as the secondary, you can see on the intraday time frames here, 4-hour chart has been more bullish overall. You've had buyers consistently print higher highs, the same time the dollar has been bullish, and we've had the Federal Reserve starting to shift their policy position. Now, The interesting part is most technical only traders to identify structure would draw a trend line. And they would say, hey, Jeev, we're breaking that trend line. We have bears in control now. But market structure is not identified based on trend lines or support and resistance zones, because a lot of that is very subjective to the individual. What's not subjective are price points. Price points are objective, and price points are what define market structure. For example, bullish market structure is being respected as long as UCAD is above the 1.263 price point. Let me explain why. As we had UCAD trending bullish, from this area here, you had buyers print an intraday high, have a pullback to this price point, collect more buy orders that went to higher highs. You can see as buyers printed higher highs here and took profit out of the market, you had a pullback to this exact same demand zone, more buy orders collected that extended to new higher highs, right? For me to switch into a bearish bias, and you can even see that this pullback still respected here, and even when this deeper pullback for the new week still respected this price point. So when you're looking at price points of interest, this is what is very objective, and this is what helps you identify if you're still maintaining market structure or starting to break it. So what this means is that you can map out some very clear-cut sells. Because if you were to see technical breaks below this price point in very strong demand zone, which has been respected since November of last year, you can identify a very easy sell to take, because what that shows you is that there's not enough buyer order flow being collected from this demand zone anymore, and we're going to have deeper pullbacks as we're starting to create this corrective pullback bearish market structure. Because the US dollar against the Canadian dollar is not only just impacted by dollar index movement. You obviously have the Canadian dollar, where the Canadian dollar has a very strong correlation to crude oil. And what crude oil has been doing over the last period of year has been trending very bullish. And even as we speak, crude oil is still at around $80 a barrel, or sitting above like $75 a barrel. So you have this tug of war, which has been creating this messier intraday price action, because you have very bullish crude oil, which is a positive for CAD, but you still have US dollar holding its individual strength, right? So with that being said, we can see this corrective pullback structure from these high points. If we were to break below 1.26 or 1.258 and US dollar stays softer in that consolidation zone and oil continues bullish, then I would see potential intraday sell plays and sell scalp plays. Okay? Otherwise, at this point on, the only way I could see buys on UCAD would be a break in retest above this corrective structure after respecting this demand zone and failing to break lower, and having a break above 275 or 283. This area here is starting to become more indecisive, and you have very messy intraday price action, and it's just best to wait for these confirms. Now, US 30 stock market index. You can see the stock market has made huge gains as the economic crisis of the pandemic was nothing but an opportunity of the rich. For the rich, sorry. The stock market since the market crash period has gone up almost 20,000 points and well above pre-pandemic levels, almost 7,000 points above pre-pandemic levels. But you can see a very common pattern, which is labeled out of the order flow transactions of buyers and sellers behind the scenes, as when you have consistent higher intraday highs printed by buyers, you can see that you do have some aggressive pullback plays to retest the bullish market structure before continuing up. we also have some fundamental confirms that can further give us more confluences to expect this deeper pullback on the equity markets, as we have these higher highs being printed by buyers and the potential for buyers to be liquidating positions, as well as sell orders starting to enter the market. Now, what are these confirms? Number one, new all-time highs printed by buyers above previous highs at 37K flat, right at the end of the fiscal year and start of the new year, which gives higher probability of profit taking and buyers liquidating positions. Number two, the Federal Reserve giving signals of potential rate hikes to come in the near term. Remember, higher interest rates are a bearish fundamental impacting factor on majority of asset classes over the last 2 years, meaning increase in interest rates is a bearish factor on oil, bearish factor on gold, bearish factor on the real estate market, bearish factor on the equities market. Because think about it from an investor perspective. The reason why the stock market was so bullish is for multiple reasons from these lows. Number one is very simple investor economics. Buy low, sell high. Over the last 2 years, in North America and in Europe, housing prices have gone up exponentially. Commodity prices have gone up exponentially, like oil and so forth. Stock market prices have gone up exponentially. Number one is because majority of these markets were at lower price points, like oil and the stock market, which had a crash, or gold, which was trending from the 14 and 1500s, or the housing market, which was not as bullish as it was from obviously 2 years ago compared to now, right? So you have investors and smart money pooling in money into these various asset classes from very low prices. That's number one. Buy low, sell high. Low prices are more favorable to buy into. On top of having low prices, you have low interest rates. Central banks across the board have very low interest rates at this exact same time. So now you have low interest rates and low prices, right? On top of low interest rates and low prices, you also have the central banks increase money supply and start to also buy these assets themselves with this imaginary printed money through their asset purchase program. So you have low interest rates, low prices, asset purchase program by the central banks. And then number four is because there's low interest rates, because they increase the money supply, you have an increase in economic inflation, which economic inflation is simply, as the name states, prices of all goods in the economies inflates. This inflation is great for the rich. All of their investments, all of their assets inflate further in price. But this inflation, this sucks for the middle class because this inflation only impacts their consumable goods. The middle class, the working class, the regular people, they're not investing. They're not the ones who are primarily in the stock market. They're not the one buying these commodities. They're not the one buying houses by the boatloads for investing purposes, right? So you have this quadruple 5 times multiplier effect for these rich motherfuckers to get even richer. Pardon my language, right? Low prices, low interest rates, the support of the central bank's asset purchase programs, and inflation, which inflates the price of all goods within the economy, okay? But now think about it. Now that over the course of 2 years, prices have gone up huge. Prices of the stock market went up 20,000 points, way above pre-pandemic levels. Houses are at record prices, record high prices. Oil went from negative $40 a barrel when it crashed back up to positive integers, $5, $10 a barrel, to now sitting at $80 a barrel. All these commodities and assets that were against the dollar when the dollar was so bearish went up extremely huge in value over the course of last 2 years. So now when you think about it from an investor perspective, the current investing environment is no longer appealing as it was 2 years ago. Why is that? Well, now we're at really high all-time high prices. We're not at low prices anymore. The same time we're at really high prices, we're starting out a new fiscal year with higher probability of profit taking and buyers liquidating positions. On top of that, we're having the central bank starting to look to raise interest rates. So now you're having high prices, high potential interest rates coming or interest rate increases coming, and the start of a new economic fiscal year cycle. It is the exact opposite conditions of what made all the investing so appealing 2 years ago. Does that make sense for everybody? It was a little bit off topic from the market update webinar, but that was a straight economics 101 breakdown of market cycles, investing, and so forth. Right? But anyways, as the central banks, as countries stay out of lockdown, as the vaccination rates continue to go up, as the central banks for these respected countries start to raise interest rates, the same time all of these asset classes and trading instruments are at very high prices. What you're going to have happen is majority of these asset classes are going to enter corrective bearish markets. I'm not saying the stock market's going to crash, but you might see a correction down to 32,000. House prices might drop $100 to $200,000 in the GTA. Oil might go back down to $50 to $60 a barrel. And this is nothing but a market cycle that's going to create a dip and continue us right back up bullish. For example, look at the 2008 financial crash. With the 2008 financial crash, you can see before the crash, you were at all-time high price points. You have a crash that has buyers liquidate positions and bring you down to more favorable demanded price points. And because it's an economic crisis, you also have interest rates very low. Low prices, low interest rates, high inflation, great markets to be buying up all these assets for the rich. But as the Fed start tapering, you get this little bit of a correction here years later. As the Fed start raising interest rates, you get this bit of a correction here years later. So what we can see now is as we've had the crash, this huge bull run, 2 years later now, as we're getting the potential interest rate hikes, it's not going to be out of the ordinary to see some bearish corrective market before continuing right back to the upside. But anyways, in terms of intraday trade ideas, we can see we're having some very strong profit taking from these highs and some intraday bearish market structure being created here as well. And we're remaining below the previous highs. Even if we get a pullback to 36,500, 36,200, that bearish structure, 36,100, or breaks below 35,850, I'm starting to see the equities market entering this potential bearish corrective stage. It's just the economic cycles. It's the signals we're getting from the Federal Reserve. It makes sense with the start of the new fiscal year as well. Okay? Last but not least, gold, our baby gold, which is doing some aggressive pullbacks here. But anyways, gold on the higher time frames, quick review that I always talk about. Here, when you saw gold do this huge bullish run during the 2008 crash, and same thing here, pandemic stage, it's the exact same thing. You have low prices on this asset class and commodity. You have low interest rates, which is favorable for holding gold and stacking into gold positions in terms of institutional buys. You have inflation increasing during this period, which is a bullish fundamental factor for gold, and you have economic fear. But as you have that bull run take place and you start to get these exhaustion confirms and you have the Federal Reserve start to increase interest rates, after peaking these high prices, you start to enter some bearish corrective structure. in a bit of a bear market, the same time you peak these high prices, you have interest rates starts to increase and US dollar trending bullish. Okay? I've talked about this a million times. You can check so many webinars. I've done 60-second webinars about this, 2-hour webinars about this. You know what I mean? There's way too much information I've given away for free. You're honestly, a lot of the information, I'm not trying to be rude or like talk, you know what I mean, be an asshole. A lot of the information I give in these webinars goes over people's heads because they don't understand the fundamental and economic concepts I'm talking about. But the beautiful thing is the Capital Hungry YouTube page and free Telegram has tons of in-house made resources that can help you understand all of these concepts. Or the Capital Hungry private channel if you really want to level up, but that's for the elites. Okay? But anyways, so on gold, we're still respecting this higher time frame bearish market structure. I still see the potential for us that if we fail to break above this previous weekly candle, which engulfed 2 weeks of bullish price action and dollar holds strength, that yes, we might dig a bit higher, but my expectations is for that weekly candle to flip bearish and for us to start making our way back down to these lows as investors price in the potential interest rate hikes to come. Okay? But on the intraday time frames here, you can see we have the potential to retest this broken bearish market structure. So this is what I potentially see. We can see clear-cut exhaustion by buyers at these previous 1830 highs, sell orders being collected at these 1830s, 1828 key level, impulsive bearish moves, which this was FOMC meeting minutes, a break and retest of bearish market structure, and new intraday lows being printed. I would personally be looking to see if we get a pullback to 1812 to retest the broken bearish market structure, still don't correct the impulsive move, as gold is known to do very aggressive pullbacks in the way it trends on the intraday timeframes. If we just get a minor pullback and come back below 1803 sells, breaks below 1789 sells. Short-term pullback if you break above this 1805 area up to 1812. But mainly with the US dollar holding strength, getting closer and closer to Fed interest rate hikes, starting to see the central banks looking to combat the increasing inflation, the exhaustion by buyers at these 1830 highs, higher time frame bearish market structure, the potential for historical repetition. I'm still in the higher time frame bearish bias, just looking for pullbacks to potential key levels and retest of structure and potential sells back down. All right, everybody. So I've been rambling on pretty long for this webinar. I don't want to make it too long. It's already been about an hour. Thank you, guys. We've gone through key fundamental points and focus, the fundamentals overall, market sentiment, analysis on the dollar, Japanese yen, volatility index, and equities. We've gone through economic events and focus for the next couple of sessions. We went through some higher time frame review on pairs, intraday analysis, and marked out some trade ideas across pairs. If you guys enjoy all this content, please do me a favor and check out all the other content on the Capital Hungry YouTube. I've been doing these 1-minute news breakdowns, which is some quick informative information within a few seconds, a minute, sorry. The 1-minute breakdowns, you have tons and tons of educational webinars, hundreds and hundreds of educational webinars, right? You have the Capital Hungry free news Twitter, which has posted almost 30,000 news tweets over the last course of a year. You have the Capital Hungry free Telegram analysis channel. And if you want more, make sure to join the Capital Hungry private channel, where for $3 a day, you get access to weekly refresher webinars, weekly psychology webinars, daily market update and trade idea webinars like we just did here every single day, daily New York scalping sessions. You get access to key level price alert tools, access to economic event reminders, psychological mental reminders, access to the community and other members' trades and analysis and so forth. You get access to the newsroom, crypto newsroom. You get access to 50 plus educational webinars. It's way too much stuff. You get access to way too much, and it's way too good of a deal. But it takes a lot of effort and a lot of time to take in all the knowledge. But I guarantee if you go through the process in the Capital Hungry private channel, you will be 10 times more ahead of where you are now. And especially compared to the general retail market. That's a satisfaction guarantee I can put money on. But anyways, everybody, thanks for watching. Make sure you check out all the links in the bio. Do me a favor, like, subscribe, turn post notifications on. Check out the other content. If you enjoy this stuff, I'll do it more often. If we can get 150 likes on this, I'll see you guys at the Wednesday New York scalping session.